In the first 2 weeks of July 2026, AI stocks lost $1 trillion. No company failed. No fraud surfaced. Nothing broke. The money just left. And economists have a map that saw it coming. 5 stages. The same 5 in the same order for 200 years? Railroads, 1929. Dot-coms, houses. Now this. So where is AI on the map? Start in Seoul. Seoul. The third week of July 2026, the Kospi drops 6% in a single session. Samsung falls 7.5%, SK Hynix 9. Tokyo follows the next morning. The Nikkei sheds 4% and closes 11% below the record it set in June. Correction territory, weeks after an all-time high? $1 trillion left AI stocks in 2 weeks, and everyone watching called it chaos. It wasn't. There is a sequence to these things, and the people who studied it saw the shape of July coming decades ago. In the 1970s, an economist named Hyman Minsky worked out how these manias unfold. Wall Street mostly ignored him while he was alive. He died in 1996. When markets seized up a decade later, traders started calling the moment of collapse a Minsky moment after the man they hadn't listened to. His colleague, Charles Kindleberger, turned the idea into a book, Manias, Panics, and Crashes. And the pattern inside it fits nearly every financial bubble on record. 5 stages: displacement, boom, euphoria, profit-taking, panic. July was a preview of the last one. To know how close the real thing is, you walk the stages in order. Stage 1, displacement, is the arrival of something new that changes the rules. The railroad collapsed distance. The internet collapsed everything else. And in November 2022, a chatbot reached 100 million users in 2 months, the fastest adoption of any consumer product in history. Within months, the next version was passing the bar exam. Displacement is the honest stage. The early money is smart money. Investors like Michael Burry hunched over the charts, marking where profit-taking will start and where panic will follow. They see the change first and buy before the crowd agrees. But the trap is set right here, because the new thing is real. The railroad really did work. The internet really did rewire the planet. Remember that. It's the whole story. The early money multiplies, word gets out, the news spreads, and the buyers bring friends. Stage 2 begins. The boom is when being right starts paying monthly. Prices rise, so more money arrives, so prices rise. Banks extend credit to keep it moving. The story hardens into common sense, and skeptics get to be wrong in public every quarter, on schedule. The cleanest boom on record, the internet, 1995 to 2000. The NASDAQ crossed 1,000 in July 1995. By March 2000, it hit 5,048. Cisco, the company selling the internet's plumbing, briefly became the most valuable company on earth. Pets.com raised $82.5 million in its February 2000 IPO and was dead 268 days later. Remember 5,048, it comes back. Somewhere between boom and euphoria, the market crosses a line. Prices stop measuring the thing and start measuring belief in the thing. In 1999, profits didn't exist, so analysts invented new units to value companies. Eyeballs, clicks, mindshare. A barber giving stock tips stopped being a joke and became a Tuesday. Stage 3 has a sound, and the sound is, this time is different. Sir John Templeton called those the 4 most expensive words in investing. So, AI 2026, the 5 biggest tech companies will spend roughly $700 billion on AI infrastructure this year. Amazon alone, $200 billion. These firms now put around half of every revenue dollar into CapEx, power company ratios priced at software multiples, and Wall Street expects the sector to borrow another $1.5 trillion over the next 3 years to keep building. The borrowing runs right down to street level. American investors now hold a record $1.4 trillion in margin debt, loans taken against their portfolios to buy more stock, up 54% in a single year. the fastest pace in 3 decades. The cash cushion behind those loans is the thinnest ever recorded. Since 1997, margin debt has grown this fast 3 times. 1999, 2007, 2021. Check what the following year did to each. Then there's the money moving in circles. NVIDIA has committed over $40 billion this year to buying stakes in AI companies. $30 billion of it went into OpenAI alone. OpenAI takes that money and spends billions of it on NVIDIA chips. We're investing $30 billion in your company. Incredible. What should we do with it? Buy our chips. With your money? It's your money now. That's the beauty of it. Picture handing your neighbor $50, and your neighbor immediately spends $50 at your garage sale. You made a sale. He got a deal. The street looks rich, and 0 new dollars exist. Then in June, OpenAI's numbers leaked. Fortune published them. $21 billion in losses against $13 billion in revenue. In the first quarter of 2026, the company lost 1.22 for every dollar it earned. Its own plan projects $100 to $15 billion in cumulative losses before profitability arrives in 2029. HSBC estimates it will need to raise another $207 billion just to keep losing money on schedule. Markets funded the 1999 version of this with applause. They are funding the 2026 version with applause. This is the stage where money changes hands from people who read filings to people who read headlines. Somewhere right now, a dentist is moving his retirement into an AI fund because his neighbor did. Stage 3 is when everyone is in the pool. Stage 4 is about who gets out first. Stage 4 is quiet. That's the point of it. The smart money, the money that entered a displacement, starts selling. Slowly, politely, into strength. Nobody rings a bell because the whole exit depends on nobody noticing. And every share the smart money sells, someone has to buy. Stage 4 needs the dentist. Michael Burry noticed the housing bubble in 2005 and made his investors around $700 million or shorting it. Today, his fund holds put options against 1 million shares of NVIDIA, plus a bet against Palantir. About $1.1 billion in positions, 80% of his portfolio, aimed at the AI trade. And from the outside, Stage 4 looks like Burry is wrong. NVIDIA is worth $5.3 trillion near its all-time high. His puts are deep underwater, but that's the shape of every early exit. He shorted housing in 2005 too, and bled for 2 years before 2008 made him famous. Stage 4 punishes the people who spot it. For a while. You're selling? The market just set a record. Records are when you can sell. And if it keeps climbing, then we lose a little. If we stay for the end, we lose all of it. We prefer a little. The companies themselves have started behaving differently too. On July 1st, Meta announced it would begin selling its surplus AI computing power to other businesses. Surplus. The people who bought every shovel in the store just opened a shovel rental counter. Worth asking why they have spares. A week later, OpenAI partnered with a chip startup called Cerebras to design processors that cut NVIDIA out of the loop. Days after that, a report that SK Hynix, the company making the memory inside AI chips, plans to slow its expansion. There had been a warning shot. In early June, a triple-leveraged semiconductor fund lost 31% in a single session. Then came the 2 weeks in July. $1 trillion gone. The number from the top of this video. On the map, that's a tremor. The first selling that didn't bounce back by Friday. Stage 4 can run for months, years, right up until one ordinary Thursday when it doesn't. Panic has a mechanical cause, and it's simple. A bubble needs new believers the way a fire needs oxygen. One day, the new believers run out. There's an old Wall Street legend about this. In 1928, Joe Kennedy heard his shoeshine boy giving out stock tips and went straight to his office to sell everything he owned. Whether it happened matters less than why it keeps being told. When the shoeshine boy is buying, there is nobody left to convert. The marginal buyer doesn't show up. Prices dip. The leverage that amplified the ride up now amplifies the ride down, and everyone heads for an exit built for 10% of the crowd. The playbook, when it arrives, is always identical. A big name misses earnings. A lender gets nervous. Margin calls. Sell. Sell the chips. Sell the clouds. Sell the fund the dentist bought. March 2000 to October 2002, the Nasdaq fell 78%. Remember 5 through 48? The index didn't see that number again for 15 years. Cisco lost 80% of its value and has never reclaimed its peak. And Amazon, the company everyone now uses to prove the internet was real, fell 94%. 94. The correct company, the right idea, the future itself, down 94%, because stage 5 doesn't check your business model on the way down. But look at what survived. Everything except the prices. The fiber optic cable laid in the boom carried YouTube a decade later. Britain's railway mania of the 1840s wiped out a generation of middle-class savings and left behind the railways. The crash destroys the money. It delivers the technology anyway. So, the verdict, walk the checklist. Displacement, November 2022, check. Boom, $700 billion a year in capex, check. Euphoria, money moving in circles. A company losing 1.22 per dollar and getting funded with applause, margin debt back at .com ratios. This time is different on every earnings call. Check. That puts AI deep in stage 3. And July 2026, Burry's billion, Meta's shovel rental counter, the $1 trillion tremor. Those are stage 4's first fingerprints on the glass. Even the professionals are using the map's own language now. The chairman of Rockefeller International went on CNBC and placed us in the advanced stages of an AI bubble. One honest complication: this bubble contains real revenue. Anthropic, one of the big AI labs, just posted its first operating profit on annualized revenue near $45 billion. In 1999 terms, this market holds Pets.com's and it holds Amazon's. Stage 5 never checks which one you are. If you want to watch the map move in real time, watch 3 dials. Whether AI revenue starts growing faster than AI spending, whether that $1.5 trillion in new debt gets repaid from profits or from newer debt, and whether chip demand holds once the circular deals stop counting. The day those dials turn, you'll know the stage changed before the news does. One last thing the map teaches. The Nasdaq lost 78%, while the internet was busy becoming the most important invention of the century. The railways ruined the people who paid for them, and the trains ran anyway. But AI is real was never the rebuttal to the bubble. Everything a bubble is built on is real. That's what makes people believe. That's stage 1.